Hello everyone. In this session, I'm going to talk about mutual funds and hedge funds. As a part of our understanding of various financial institutions and the risk management process, we have looked at the banks, the insurance companies, and the pension funds. So now we are trying to look at mutual funds and hedge funds, the kind of financial transactions that they get into, and the typical risk management, the kind of risk they are exposed to, and what are the various risk management aspects that they typically get into. So, a quick introduction regarding mutual funds versus the hedge funds. We'll talk about type of mutual funds, wherein we bring in open-ended, closed-ended, and even the exchange-traded funds. So we are talking about the type of the funds. What is the way in which we compute the net asset value of a mutual fund? The computation procedure for the same. Then we will move towards hedge funds. We will try to understand the difference between the mutual fund and a hedge fund. Then how do I really compute the returns on a hedge fund investment? What are the various incentives with respect to fee structure of a hedge fund? So what are the kinds of temptations that a hedge fund manager will have compared compared to mutual funds? So why would the hedge fund manager be willing to take more and more risk in the investments compared to a mutual fund manager? So we will talk about different kinds of terminologies that are involved in the process. Then we will bring in the various hedge fund strategies. So around 8 to 10 different strategies which typically the hedge fund managers get into and specialize in. So those are the different kinds of strategies that we are going to talk of. And towards the end, we will try to understand what are the different kinds of risks that are faced by hedge funds and how do I really measure the performance of the hedge fund. So these are the different topics that we are going to take up in this session. So let's get started. So whether it is mutual funds or hedge funds, they pool the money from the individuals and from companies. They pool the money, they collect the money, and these funds, they do the investments on behalf of the individuals and the companies. So basically we have different individuals and companies contributing the money to a mutual fund. This mutual fund will again invest in different kinds of investment. Probably they may invest in equities, they may invest in bonds, they may invest in money market instruments, so many things. And whatever the returns that each one of them is giving, they are in turn passed on to the investor. That's the typical strategy that is followed by the mutual fund. So the funds from different investors, they are pooled, and based on that pooling, the investments are chosen by the fund manager. A mutual fund is having a fund manager who is a professional. So if we are investing directly, we may not be having that much of experience and expertise in terms of where to invest, how much to invest. But when we are going through a mutual fund, we are giving the right of investment to a professional whom we expect that can manage the fund, manage the investments quite cleverly, and they can meet the required objectives. So generally the mutual funds are more and more targeted towards small time investors who cannot directly invest all their money in multiple securities. They cannot diversify their investment because they have a very small pool of money with them. Buying shares from, they cannot buy a portion of the shares. So which means they cannot invest, they cannot diversify that easily if they are going as an individual investor. But through a mutual fund, they get a lot of diversification opportunities because even in case of mutual fund, it's a pool of investment. So there might be a possibility that my share of investment could be only a small proportion of one. It may not be a one, it may be a small fraction as well. Whereas directly I cannot buy a fraction of a share. So this is where mutual funds could be helpful. But coming to the hedge funds, they are purely on the other side, though they are also funds. They also pool the money from individual investors and companies, but they are not targeting the small time investors. They are more majorly targeting the wealthy investors and big companies like pension funds who have large amounts to invest, who have a large amount to invest. So the target for hedge funds is they also pool the fund, they also invest the monies of the individual investors, but the profile of the investors is they are all highly wealthy individuals and even the firms which have large amounts of money to invest. So pension funds is a classic example for that. And because they are targeting all the high net worth individuals and firms, the regulatory aspects are much lesser applicable to them compared to mutual funds. So different kinds of trading strategies they can use, whereas in case of mutual funds there are so many limitations with respect to the trading strategies that they can use. The shorting is not allowed in the mutual funds. Mutual funds cannot use derivatives beyond a certain point, whereas such kind of restrictions do not apply to hedge funds. So they have so many options to choose from, wider range of investments to choose from. So and even the regulatory aspects are much lesser. And the disclosures are also much lesser in case of a hedge fund. They can maintain the entire investment profile secretly, whereas that is not the case of mutual funds. So some differences are very clear from these perspectives. In the mutual funds case, they have to very clearly disclose all their investment policies in the prospectus. So what kind of strategy they are going to adopt? Are they going to adopt a growth strategy? Are they going to adopt a value strategy? What kind of strategy are they going to adopt? What is the proportion of investment they are looking at, equity, debt, etc. All these things they have to very clearly specify as a part of their prospectus. So money market mutual funds, if you look at the different types of mutual funds, one we can see money market mutual funds, they generally invest in very short time investment, treasury bills, commercial papers. So all these things if you see, they have a life of less than 1 year. So all the money market mutual funds, they do their investments in all those securities whose life is for less than 1 year. Right? So those kind of funds where the life is less than 1 year, we call them as money market mutual funds. Whereas all others which are greater than 1 year kind of an investment horizon, we call them as long-term mutual funds. And within the long term, we can very well segregate them into bond funds, where the investments are primarily into fixed income securities, equity funds, where the investments are primarily in the common stock and the preferred stock of the companies, hybrid funds which invest both in stocks, bonds and other securities. So all these are different variants of long-term long-term funds that are available for the investors. Now looking at the type of mutual funds. So anytime if I am typically buying if I have invested in a mutual fund, right, especially the long-term mutual fund, if I have invested, it means that I own a few shares in the mutual fund. Just like I own a few shares of a stock, I own few shares in a mutual fund. If I have invested in a particular fund, it means that I own a certain number of shares in the fund. Funds wise, they are classified into open-ended funds and closed-ended funds. And the major difference between the two is in open-ended, word itself open-ended. So there is no restriction on the number of shares that are issued by the company. So if I keep buying more and more shares, the total number of shares will go up. If I keep selling more and more shares, redeeming more and more shares, the total number of outstanding shares will go down. So there is a fund, I am buying into the fund, I am selling the shares of the fund. So I am buying new shares, the number of shares are going up. I am selling existing share, the number of shares are going down. That is why we are calling it as an open-ended. Whereas in closed-ended, that is not the case. The number of shares that are outstanding is fixed. Just like a company's stock. Even for a company's stock, the number of shares that are outstanding is always fixed. It's only a trading that can happen. I can buy from you, you can buy from me. No new shares are created in the process. The same thing happens in case of a closed-ended mutual fund also. It's only a transfer of shares that can happen, no new shares can be created. Whereas in case of open-ended, that's not the case. The buying and selling both are happening to the fund itself, not between the traders. So if I buy more shares, then probably the total number of shares is increasing. If I sell some of the existing shares, the total number of outstanding shares is going down. Investors pay the tax in the same way as they are owning the securities. So they are subjected to income tax as well as the capital gain tax. So when they are getting dividend income, they are paying income tax on it. And when they have sold the shares and they have got a profit out of the shares that they have sold, then there is a capital gain tax that is involved on it. Whereas in case of a closed-end fund, just like a stock exchange, where the shares are traded, even the closed-ended mutual funds are also traded. But that is not the case in case of open-ended mutual funds. The buying and selling is happening directly to the fund, which will result in increase in the number of shares or decrease in the total number of shares. It's not a transfer of shares. And apart from these two categories of funds, nowadays, in the last couple of decades, another new category of funds have come more and more famous into the market. That is an exchange traded fund which will track an index. And it is generally useful for the investors who think that the return, whatever they are getting, if it is more or less mimicking the index, if they are fine with the return that the index is generating and they want a return more or less on the similar lines of the index, then this is a good product for them. Generally, the ETFs are created by institutional investors. Now it is like this. They deposit different blocks of securities, security 1, security 2, security 3, security 4. They deposit different blocks of securities with the ETF, and in turn, corresponding to these blocks of securities, they get the shares. In the ETF, they are getting the shares. And these shares are traded just like a closed-ended fund. So that's where ETF has the characteristics of a closed-ended fund because it is traded on the exchange. But when it is traded on the exchange, the market price will keep varying based on the demand and supply. But based on the demand and supply, even the fund manager can either increase the number of shares or decrease the number of shares so that the market price fluctuation is not that heavy. So to ensure the difference between the traded price and the fair market value, The institutional investor keeps buying or selling the shares, and because of that you will find that this characteristic is more or less similar to that of open-ended, because the total number of underlying shares can either be increased or decreased in case of ETF. So this is the characteristic of an open-ended fund, and because it is traded on the exchange, that becomes the characteristic of a closed-ended fund. You will find that the exchange traded fund have mixed characteristics of both open-ended as well as the closed-ended fund. Then looking at a few differences between ETFs and the open-ended funds. So in the open-ended funds, the purchase or sale, though it can happen at any point, but the price at which we are doing the buying or selling is based on the price that is determined at the end of the day. So all buyings and sellings happen at the same price in a particular day. Whereas that is not the case in case of exchange traded funds. The buying and selling can happen at any time, and the price also could keep changing across the time. And shorting, that is one more advantage. They can be shorted in the same way as the shares. So whereas that cannot be possible in case of open-ended funds, you are buying and selling both to the fund itself. So the holdings are disclosed twice a day. How much the ETF is holding, what is the total number of assets that are associated with the ETF, that disclosures are done twice in a day. So the investor is having full knowledge of all the assets that are underlying the fund. Whereas that is not a necessary rule in case of mutual funds. The mutual fund manager need not disclose the composition of the assets that frequently. Now coming to selling the shares, right? Let's say I have invested in an open-ended mutual fund, right? Like me, so many people have invested. Now this mutual fund has again invested in some shares of some companies. Let's say I want to close out my investment. I want to exit out of my investment. Now this mutual fund manager, he may have to sell off some of the shares so that my payment can be made. Whatever the amount that needs to be given to me may have to be done. And because of which the fund has to actually raise the cash by selling some of the existing investments so that they can fund my redemption. Whereas in case of ETF, let's say I want to do the redemption here, I can reduce the number of shares in the ETF directly. So because someone else is providing the cash here, and because of that reason I don't need to sell off any other investment, I am simply mimicking the index, so the number of shares in the ETF will be directly reduced, outstanding shares will be reduced. So there is no need to really sell off some kind of a profit making kind of investment. So that's one major advantage you could see with exchange traded funds. The transaction costs are much lesser. Expense ratios are also much lesser. The costs that are involved in case of ETFs are significantly lesser compared to the costs that are involved with the mutual funds. And just to understand some kind of specific costs that are associated with the mutual funds, we talk about a front-end load and a back-end load. Especially when any fund charges a fee when the investor first buys the shares, that is called front-end load. At the time of buying, if there is an extra fee that is being paid by the fund buyer, we call it as a front-end load. And if there is an extra fee that the buyer is paying, especially when he is redeeming the shares of the fund, it is called as a back-end load. So we need to observe whether the fund is having any of these kind of loads which would increase the cost to the investor overall. And when we are using the word total expense ratio, it's the total annual fee that we are paying for this fund divided by the value of the share of each of the shares that is present in the fund. Then the For a mutual fund, we typically compute the NAV, net asset value. Though it is computed for open-ended fund and closed-ended fund in a different way. In case of open-ended fund, every day at 4 p.m. So all the assets that are there as a part of the fund. So I know this fund has these as the assets. So the mutual fund manager identifies all the assets that are there as a part of the fund. He looks at the market value of each of the assets at 4 p.m., multiplies them with the number of units that are invested for each of these assets, and compute the total value of the fund. And out of this, if there are some kind of liabilities that are there, they would be subtracted from the fund. This is the total value of the fund, and from there any liabilities, if existing, they would be subtracted, and whatever is the difference that is there, that would be divided by the number of outstanding shares, and that is what we are calling as NAV per share, net asset value. So I am talking about net asset value. So the asset value is this one, and when I am taking out the liabilities from it, it is becoming the net asset value divided by the number of shares, saying me net asset value per share. So anything, if a person is buying a new shares from the fund or he is selling existing shares back to the fund, the buying and selling is happening at this particular price itself. So though the buying and selling can happen to the fund at any time, the price at which it would be bought or sold is based on the price that is determined at 4 p.m. It is the next calculated NAV that is applied to the transaction. So today if I want to buy the shares of the fund at 2 p.m., whatever is the price that is going to be at 4 p.m., whatever is the computation that is done at 4 p.m., that is the price at which the buying will happen. Though I have initiated the trade at 2 p.m., I would be buying the shares of the fund only based on the NAV that is computed at 4 p.m. So any kind of buyings and sellings that I have initiated during the day, they would be executed based on the price that is determined at 4 p.m. on that particular day. Important point that you have to keep in mind. Coming to the closed-ended fund, NAVs, there are two definitions of NAV here. Because the closed-ended fund is directly traded on the market, I can directly look at the price at which it is traded in the market. I can take that as a definition of NAV directly. So that is purely based on the market price, the price at which the shares of the fund are traded. Whereas NAV2 talks about the market value of the fund's portfolio, just like the way we have computed the NAV in case of an open-ended fund. Here the NAV2 is exactly the same. We are looking at the market value of the fund's portfolio, dividing it by the number of outstanding shares, which is what we are calling as the fair market value of the fund, and that is also being computed as NAV2. And in general, what we see is NAV1 is generally lesser than NAV2, because in case of a mutual fund, there are some fees that are typically being paid to the fund managers as well. So more generally, you will see that NAV1 is much lesser than NAV2. Then, moving from mutual funds to hedge funds. In case of hedge funds, the regulation part is very, very limited, because the funds are accepted from very, very sophisticated individuals and organizations. The funds are typically collected from people who have a sound financial understanding, who have very large amount of funds and who want to invest them in different kinds of innovative instruments. So that's the reason the regulatory aspects are much lesser in case of hedge funds. If you want to look at the typical regulations that generally come up on mutual funds, so mutual funds should be very much ready. There is a possibility that if I want to redeem my shares in the mutual fund, the fund should be able to provide me that kind of a facility. At any time, if I want to redeem my shares, the fund should be in a position to give my cash back. That's one major regulatory aspect that is there on the mutual fund. NAV needs to be calculated daily based on the value of the market value of the different assets that constitute the fund. So in what kind of assets the fund is investing, what is the investment strategy, all these things have to be very clearly disclosed in the prospectus itself. Very rarely there could be a kind of a deviance of the fund manager from the basic objectives. And even the usage of leverage, right, using the borrowed funds for investment or even a virtual borrowing, even those kind of aspects, they are very limited in case of mutual funds. But all these regulations are not applicable at all in case of hedge funds. That is where the hedge funds have got lot of additional mileage compared to the mutual funds. So hedge fund implies that the risks are being hedged altogether, but the reality is the word hedge is a kind of a misnomer out here. They are not mitigating any kind of risk. The hedge fund managers, they take very aggressive bets in the future direction of the market, and there is no kind of a hedging as a mechanism that is involved in the process. And the fees that the hedge funds typically charge are very high, and in many cases that the fee that they charge is very much linked to the performance of the fund as well. So there are two major components, one being the annual management fee, which is more like assets under the management. So generally 1% to 3% of the total assets under management is charged as an annual management fee. But you look at these numbers, the incentive fee is something that is skyrocketing. 15% to 30% of the realized net profits, especially if the profits are positive. So that is the motivator for the hedge fund managers to take risks and invest very heavily. The general terminology is 2 plus 20%. It means that this particular hedge fund carries an administrative fee or the annual management fee of 2%, and along with that there is a 20% incentive fee, which is over and which is the kind of performance related fee that the individual, that the fund manager is going to get based on what is the level of profitability that that particular fund can generate in that particular year. Whereas in case of mutual fund, they should be very much prepared to give back the cash if the shares of the fund are redeemed by the investor. Whereas there is a definite lockup period in case of hedge funds. Probably every investor has to keep the funds at least for a minimum period of 1 year. There is a lock-in period. During this lock-in period, he or she cannot withdraw the funds at all. So this is one more difference that is very striking and significant between the hedge funds and the mutual funds. Now, if I have to calculate the return on a hedge fund investment, let me look at the situation here. Suppose the hedge fund manager is presented with an opportunity where there is a 0.4 probability, which is a 40% probability of 60% profit, right? There is a 0.4 probability of a 60% profit and a 0.6 probability of a 60% loss, which is a minus 60% profit, with the fee earned by the hedge fund manager being 2 plus 20%. Now let's see, if at all if this is the case, if it is not the hedge fund, I would typically look at it like the expected return of this fund is 40% times 60% plus 60% times minus 60%. So this is resulting in a 24% minus 36%, resulting in a minus 12%. So because the expected return is negative, I would not even think of considering the investing in this particular portfolio, in this particular investment. But look at from the risk taking perspective of the hedge fund manager, right? So now there is a 2%, that is a typical charge. Let's leave that 2%. But if you look at the overall, which is including the performance fee, so there is a 40% chance that the fund will generate a 60% profit. If the fund generates a 60% profit, the kind of benefit that the fund manager is getting is 2 plus, right, 2 plus whatever is the 20% of the remaining 58, because 60 is the profit that he is generating. Out of that 62 is going out, let's say for out of that 62 is going for fund management expense. So out of that 58 is going to generate this 20% as an incentive, and at the same time there is a 60% chance that he will go into a loss. In that case he will not receive the incentive, so the overall return is just 2%. So if you are looking at it, it is 0.4 times 2% plus what is this, 11 point, so let's aggregate 0.4 times 2% plus 0.4 times 11.6% plus 0.6 times 2%. So overall I can take this as 2% plus 0.4 times 11.6%, which is becoming 4.64%, and overall it is 6.64% return. So overall, on an average, the average return to the expected return to the hedge fund investor by taking this risk is 6.64%. Out of that, you will take out the 2% which is for the fund management. So overall, the expected return is still 4.44%, which is positive. So that is what is prompting him to go for the risk. Whereas in a regular case, he would not go for the risk because it's resulting in a minus 12% return. But look at it from a hedge fund investor's perspective. What is the return that he is getting? So let's assume that there is a 40% chance that the 60% profit came up. So out of that 60% profit, right, out of that 60, he has already paid 2, which is for the fund management, and along with that he has already paid the incentive, which is to the extent of 11.6 bucks. So what he is left with is this much. Out of that 60%, 2% is already paid towards the fund management expense. 11.6% he has already paid towards the incentive. So that is what he is left with. Whereas in a 60% chance that he is left with a minus 60, right? He is left with a minus 60. That is what is the loss that the portfolio has generated. And along with that, he has also lost the 2% because he has given that as an incentive. So now if you look at 0.4 times 60% minus 11.6%, right? 60% minus 11.6% is 38.4%. Now 0 0.4 times minus 0 0.4 times 2% minus 0.6 times 2% and minus 0.6 times 60% is minus 36%. So these two are coming out to minus 2%. So it's coming out like 0 0.4 times 38.4% minus 38%, which is resulting in right 13.6% or 15.6% minus 38, resulting in a minus 23 kind of a percent in case the fund manager has in case he has invested. From the hedge fund investor's perspective, it's a big loss to him, right? Because he has his portfolio has generated a 60% loss, whereas if in case it has generated a 60% profit, there is some amount that he has got overall, resulting in a minus 20 plus percent negative return to the hedge fund investor. Whereas from the hedge fund manager's perspective, it's still a positive number, and the overall put together is something that would still work out to the same minus 12%. So that's the simple logic, right? We are looking at from the hedge fund manager's perspective as well as from the hedge fund investor's perspective. So in case of hedge fund investor, so look at it straightforward. Overall it is 0 0.4 times 60% plus 0.6 times minus 60%, right? This is what is the general scenario. But in case of hedge fund, because of the incentive structure, we are saying 0 0.4 times. Now what the manager is, the hedge fund manager is getting is 2% plus on the 58 he is getting 20%. So this is what is the amount that he is getting out of the 60, and here he is still getting just 2%. So this is what has resulted in, so this being 11.6 plus 12, 11.6 plus 2, resulting in 13.6, right? 13.6 into 0 0.4 plus 0.6 into 2, whatever it is. So this is the kind of a return that the hedge fund manager is generating. Whereas in case of hedge fund investor, okay, out of the 60, he has lost this much, right? He has given this much as the benefit, as an incentive to the hedge fund manager, whereas similarly, there is a 0.6% chance where he has lost 60%, and on the top of it, he has also given the 2% as well. So these two things put together, if I'm adding it up, this whole thing should come out to minus 12% itself. So that's how I have to segregate the overall expected return of minus 12% between the return what the hedge fund manager is expected to receive and the hedge fund investors are expected to receive. And because the expected value is very much positive in case of the hedge fund manager, that is where he would be tempted to, that is where he would be tempted to go forward with the investment, so that on an average the expected return is still positive for him. Now this is one area where the investors have a big drawback, and they have to start pulling into the system, try to put some kind of restrictions on the hedge fund manager so that all the undue risk will not be taken care by the hedge fund manager. Now this is where the incentive fee structure of a hedge fund really plays a role in. As a part of that fee structure, generally a hurdle rate is being set, which talks about the minimum return that the hedge fund needs to generate in that particular year so that the incentive will be applied. Not that every time the incentive is directly applied. So there is a minimum amount of return that the fund has to generate. So from there only the incentive will be applied, and that is what is being set as a hurdle rate. So this hurdle rate puts a cap on the incentive of the hedge fund manager. Similarly, there could be a high watermark. The watermark simply says, okay, if this year, if the loss is 30%, in the next year, this person will receive an incentive only if he is generating a profit above this 30%. First, this losses have to be completely overcome, and only after this losses have been overcome or recouped, and anything that is above those losses, which means the new profits that have generated, they should cover all the previous losses that have come, and only after that the insurance fee, the incentive fee will come into picture. That is what is the watermark provision. And not necessarily the same for all investors, because I might have invested last year whereas you might have invested from this year itself. And because I have invested last year, I had a loss of 30% last year. Now, from my perspective, I will give this fund manager an incentive only if he has covered my last year's 30% loss, and only if he has generated more than 30% profit this year, then only the incentive is eligible for him. Whereas you are an investor who are investing this particular year, you don't have any kind of losses in the previous year, so you would not mind directly giving him an incentive. So this watermark need not be necessarily same, because different investors might have got into the investment at different points in time. So this has to be calculated separately for each of the investors. And along with that, there could be a proportional adjustment clause also along with high watermark, especially if the funds are withdrawn by the investors, right? Okay, let me give you an example. So initially the fund is a $200 million fund, right? And the fund has at the end of the year there were losses of 40 million on the fund. So the fund value has become 160 million. Now let's say suddenly 80 million of the capital is withdrawn from the fund, right? The investors have withdrawn 80 million capital after 1 year. So which means almost 50% of the capital is withdrawn. Now, first of all, for the incentive to be applied, we are saying that the hedge fund manager should generate a profit above 40 million. If he has generated a profit of 20 million, he will not be eligible for an incentive. He has to generate a profit above 40 million. But now if you see, the 40 million has to be generated on the 80 million fund that is there, because 80 million is already withdrawn. Now this is where the proportional adjustment clause says, okay, now that 50% of the capital is withdrawn, even this target also can be changed to 50%. So now the fund manager will be eligible for incentive if he has generated a profit above 20 million, and above anything above 20 million he would be eligible for an incentive. So that is what is the watermark structure that could be there as a part of the hedge fund. Then there could also be a clawback provision, which is like, in case you have generated losses in the current year. Last year you have generated a profit and you have taken, let's say, 20 million as an incentive. But this year you have generated the losses, and because you have generated the losses, Instead of simply saying I will not give you an incentive this year, there is also a provision for clawing back. Means I can I can very well recover some of the incentives that I have given to you in the last year. For the current losses that I am bearing, I can recover all or a portion of the incentives that I have given to you in the past. So there is a recovery account. Whatever is the incentive that I have given you earlier, some portion of it is always set into a recovery amount, and this is typically used to compensate in case there is a big drop, in case the portfolio has generated huge losses in the current year. The compensation on that portfolio can be typically done by using the recovery amount, where some portion of the incentive that has been given to the hedge fund manager is being set aside as a separate account. The fee structure, as we have seen in the earlier numerical, the fee structure generally gives the hedge fund manager a big incentive to take high risk. And having all these kinds of clawbacks, hurdle rates, watermark will really put some kind of cap in terms of high risk taking ability of the hedge fund manager. Because traditionally, if you look at the hedge fund manager, he is having a call option on the assets of the fund. So it is like he can only, the more and more, if it goes successful, he can make unlimited profits, but his losses are more or less limited to the extent of clawback that they are doing, or to the extent of the funds under the management. So he is not having unlimited losses in the process unless the clawback levels are much higher, the hurdle rate is set much higher. Otherwise, he is not having any kind of big losses, but the profit potential is literally unlimited. So that's the reason he would not mind taking a higher risk in the process as such, right? So once we got a clarity on the incentive fee structure of a hedge fund, now we will move on to try to understand the different strategies that are typically engaged by the hedge fund managers. So very common strategy being the long short strategy. So this is one of the oldest hedge fund strategies that has been used. It has been used for quite some time. The hedge fund manager, he is going to identify a few set of stocks which are considered to be undervalued and a few set of stocks that are overvalued. So that is the typical identification process that would be done by the hedge fund manager. So a few stocks which are undervalued by the market and a few stocks which are overvalued by the market. So in all those stocks which are undervalued is going to take a long position, and all those stocks which are overvalued is going to take a short position. So what happens if they are undervalued? Their price is going to go high in the future. Their price can increase in the future. So because he has gone long, he is going to make a profit here. And because this particular stock is overvalued, the price of that is going to go down in the future. And then at that point he can buy back that stock. Again, this strategy also could result in a profit. So it's a double profit that can come out by going ahead with this long short strategy. So if the stocks are picked well, the strategy will give much good returns irrespective of the markets. Even if the market is bullish or bearish, the profits are going to be made in this strategy. And here the focus of the hedge fund manager is not on the general stocks, which almost every analyst is researching. So generally the focus is on very small stocks where the analysts do not generally focus. They do not cover as a part of their detailed analysis. So those small stocks would be researched by the hedge fund managers. They will see whether these stocks are overvalued or undervalued, and based on them they would try to position their payments, position their investments accordingly. In some cases, instead of exactly balancing the long and short, they may have a net long bias, means they would have majority of the long positions, very few short positions. So overall there would be a net long, or they can engage a net short, means more number of shorts and less number of long positions also could be there as a part of this strategy. So there could be an equal number of longs and shorts, or in a net long strategy they could have more number of longs compared to the shorts. Net short strategy where there could be more number of shorts compared to the long. And coming to the within this long chart, so there are a few more improvisations. Equity market neutral fund. So the longs and shorts are always matched. When you are saying we are creating a equity market neutral fund, in that long short strategy itself, the longs and shorts are matched in some way. So they could be matched dollar wise. So if I am having $1,000 worth of long positions, I will also have $1,000 worth of the short position. So that is what is a dollar neutral fund. Or I can go with a beta neutral fund. Weighted average beta of the long position should be equal to the weighted average beta of the short position. So the net beta will always be 0. So when the net beta is 0, the investment is completely insensitive to the market movements. So even that kind of a neutrality could be there. Or sector neutrality. In each sector, I would try to balance my long positions with the short positions. Similarly, I can create a neutrality with respect to the external factors like crude oil prices, interest rates. So if I have gone long on interest rates, I will choose investments where I am going short on the other interest rates as well. Similarly, the inflation. So the neutrality could be there with respect to the factors as well. So all these are different kinds of long short equity strategies that are followed by the debt fund managers. In some cases, there could be a dedicated short strategy where they will not look at going long at all. They are primarily looking at overvalued companies and go short. In many a times, we observe that the regular brokers and the market analysts, they generally don't want to give sell recommendations that easily. They just give buy recommendations so that they can please the management and get much more business from them. So it's very, very rare, unless things are worse, they don't give sell recommendations that easily. Now this is where the hedge fund managers take advantage of, because the regular analysts, they don't give a sell strategy that easily. The hedge fund managers try to look at those securities which are heavily overvalued and initiate the sell transactions on them. So some of the things that they focus on: companies having very, very weak financial statements, they get into identifying those kind of companies. Those companies whose auditors are changing quite frequently, they identify that these are very overvalued kind of firms. Those kind of companies which delay the filing of their financial statements frequently, even they are treated as overvalued kind of companies. So these are the ones where they would like to go short on. If there is overcapacity in a particular industry, and we are talking about a few firms in that overcapacity industry, so there also a shorting could definitely work. So, and even lot of short sellers existing, companies attempting to silence their short sellers or suing them, they are all indications that there is a possibility of overvaluation associated with that firm's stock, and a better strategy would have been go short on it. So that could be a strategy which can be followed by a hedge fund. Then there is a distressed securities investment strategy. We have to understand the difference between the non-investment grade or a junk bond versus a distressed security. When we are talking about a non-investment or a junk bond, anything that is having a credit rating of double B and lower, those kind of bonds, the companies which have issued the bonds, the companies with credit ratings below double B, if they have issued the bonds, those ratings are those kind of bonds are called as non-investment grade or junk bond. But if the credit rating is triple C, which is on the border of default, those kind of securities are called as distressed securities. And most of the cases we find that the distressed bonds, they have to give a very high yield. So they have to get sold at a much bigger discount to the par value. And the managers, the hedge fund managers, they generally calculate a fair value by using their own set of formulas, by using their own set of futuristic scenarios and their associated probabilities. They understand the fact that the bankruptcy proceedings lead to a reorganization or a liquidation of the company. So in the liquidation, in the case of liquidation, who is going to receive how much? What would be the typical recovery rate? What would be the action that could be possible by the management? All these things would be thoroughly understood by the hedge fund managers. And based on that, they can choose either of these two strategies. They can simply be a passive investor where they buy the distressed debt and they just wait for the firm to go bankrupt. And based on that, once they go bankrupt, they will try to see how they need to get the proceeds out of that investment. Whereas in the other case, they can take a very active strategy where they take a very large position in that distressed debt. So because of that, they will have a right to influence because their position is so big, they will have the right to influence the reorganization proposal. So some of these strategies are very much followed by the hedge fund managers. So they look at these distressed securities, try to get bigger profits out of the investments in the distressed securities. Then we can talk about merger arbitrage, especially trading after a merger or an acquisition is announced, under the hope that the deal will take place. Now here we have two examples to look at. Let's assume that the deal is a cash deal versus a share exchange deal, share to share exchange deal. So in a cash deal, take this example. Suppose company A has announced that it is ready to acquire all the shares of company B for $30 per share. And at that time, let's assume that the company's B shares were trading at $20 per share before the announcement. So immediately after the announcement, we see that the share price of the company B is going to shoot up. It might go up to $28. It may not touch $30 because sometimes there is a possibility that the deal may not get through. So because of that reason, the share price might go up to 28 but not up to 30. Now what a merger arbitrage hedge fund will do is, it will buy the shares of company B at 28 and just wait. So if the deal gets through, that's a huge profit for the hedge fund, but if the deal does not get through, that is where it is going to lose heavily. The same logic, even if it is a stock swap or a share per share exchange. So suppose the company A has announced that it is willing to exchange one of its shares for 4 shares of company B. So for every 4 shares of company B, it will give 1 share of company A. Now let's say at that point in time, let's assume that the company's B shares are 15% of the company's A shares. But because it's a 1 to 4, so they can go up to 25%, right? But generally once the announcement is made, let's say they will shoot up to 22%. Now again the same logic will come into picture. They will buy a certain amount of company's B share, and if required they can also short some number of shares of company A. So this is expected to go up in price, this is expected to go down in price. In both the cases, the profitability is going to be made. and that is where we are calling it as an arbitrage. Arbitrage is a place where we are taking both long and short positions simultaneously. So we could see that we are going long on the shares of the target company and we are going short on the shares of the acquiring firm. So this kind of merger arbitrage strategies can generate steady but not abnormal returns. Similarly, there could be a strategy associated with a convertible arbitrage. So there are sophisticated models that are developed by the hedge funds for valuing the convertible bonds. And we know that convertible bond pricing is a very complicated process because how the underlying stock price is changing, it has to be converted into equity. So the option pricing and option valuation come into picture for convertible bond. So the volatility of the underlying stock, the interest rates, various parameters are considered to understand the price of a convertible bond. So in many real world scenarios, you see that the convertible bonds are typically priced below their fair value. Now this is what the hedge fund managers typically take advantage of. They buy the bond and hedge the risk by shorting the stock. So because of this reason, they go long on the bond, right? Wherever the convertible bond possibility is there, they go short on the stock. So now you could see if they are going long on the bond value, if it increases in the future, they are making a big profit. And similarly, the share value will fall in the future, because of which also they are making a big profit. And interest rate risk and credit risk that are associated with respect to these bonds, right? The interest rates may fall and the value of the bond could get affected. Or similarly, the credit risk associated with the default of the bond. So in that case, they can very well short the non-convertible bond, so that the same bond, the non-convertible version of it is shorted. So credit risk is eliminated because the value will change more or less in the same way. The interest rate risk and the credit risk, both of them are eliminated. Or even various other things to hedge the interest rate risk and the credit risk are there. They can take the derivatives market where they get into the interest rate futures, asset swaps, credit default swaps, any other kinds of instrument to mitigate that risk that is associated with the volatile interest rates and credit risk. Similarly, you have a fixed income arbitrage strategy that they can go with. So where you could see a relative value strategy, the word is very clear: buy the cheaper one and sell the expensive one. So they are buying the zero coupon yield curve bonds which are undervalued and sell the ones that they are overvalued. That's a relative value strategy. And market neutral, overall they make sure that the market is nowhere exposed to interest rate movements. Even if the interest rates go down or go up, we are not that much impacted at all. Or in some cases they will try a directional strategy. They will have some kind of a betting on the movement of the interest rates. They feel that the interest rates are going to move up in the future. So they will try to position their investments in such a way that the market moves in this direction so that they will get the benefit out of it. So they have some kind of a belief, one either relating to how the interest rates are going to move in the future, or in some cases they may even plan on the spread between the interest rates, and based on that they will create their long and short positions accordingly. And a few other strategies that may come up here: emerging markets. These are not arbitrage strategies. So some people or some hedge fund managers, they specialize in the investments in developing markets. They look out for the shares that are overvalued and undervalued, especially in the emerging markets itself. They invest in the securities which are traded on the local exchange, or they will even purchase the American depository receipts, or they can also invest in the bonds of those emerging market countries. So they expect that in the emerging markets the returns are going to be much higher than expected. And there are a few strategies which are typically global macro strategies. based on how the global macroeconomic variables are expected to move, the trades are placed accordingly. So wherever the markets have moved away from equilibrium, the research would be conducted, identify those markets which have moved away from equilibrium, and the positions will be taken in those markets under the simple assumption that the markets will have to move back to equilibrium at some point or the other. So because of that mispricing, they will try to, because of that unequilibrium position that is existing, they will assess that inequilibrium position, and based on that they will have a position on their investment, so that once the market comes back to equilibrium, they can very well make the profit out of the overall process. So that's one more thing going as a part of the global macro strategy. Generally, the betting would be there more and more on exchange rates and the interest rate. If the exchange rates have gone out of equilibrium, they'll take a position under the assumption that the exchange rate will again come back to equilibrium. The same logic is applicable to the interest rates also. They will assume that right now the interest rates are away from equilibrium, but at some point the interest rates can again move back to equilibrium as such. Right? Then, the other strategy that could be looked at in this context is the managed futures, where there is an attempt to predict future movements in the commodity prices. So, there will be a research that is performed in terms of assessing the future movements in the commodity prices, which could be done through a judgmental process. There could be a sophisticated technical programming, computerized programming that is done to assess the prices of the commodities. There could be a strong technical analysis or a fundamental analysis performed to finally predict what could be the future movement of the prices of the commodities. So there is a sufficient amount of backtesting that is done, especially when you are going with the technical analysis using historical data for making conclusions regarding the futuristic performances. So appropriate backtesting, testing with the historical data has to be done before rolling the strategy forward. So the hedge fund managers have so many such kind of strategies available at their disposal. They have to choose, or they will specialize in one or few of those strategies across, and they will try to invest in these strategies and try to generate much bigger returns than what a simple mutual fund managers are doing. And coming to the next aspect, the risks that are faced by the hedge funds, they have to they are doing into a short strategies. They have lots and lots of short positions. So corresponding to that short positions, they have to borrow the securities. And if they have to borrow the securities, a large amount of collateral need to be posted. So when the position is losing money, it so happens that more and more collateral has to be posted. Otherwise, the trades will be closed off, and then they get into a much bigger losses. So they have to understand the risks that are associated with the short positions and the collateral that needs to be posted. One important point that is very essential to understand in the context of hedge fund is whatever the trade that it has entered into, understand that that trade might be correct in the long term, but in the short term it might lose money. So because of that reason, so in the short term, if it is losing money, more and more collateral need to be deposited, and in case the collateral is failed to be deposited, the position had to be closed out, which may result in a huge loss. So most of the times in case of hedge funds, huge losses are occurring because of the collateral posting, because of not being able to generate that kind of liquidity in the short term, and short term cash flow crisis is what has caused the downfall to majority of the hedge fund. So some amount of an understanding of sources of short term liquidity and short term capital are very essential in case of running a hedge fund. And coming to the performance of the hedge fund, one thing, it is not mandatory that they have to report all their performances. So There is no data set that records all the returns of all the hedge funds because the participation is pretty much voluntary. Especially the small hedge funds with very poor track records, they do not report. So they are not included in the data set. So overall performance looks very rosy. The average performance of the hedge fund looks, average returns of the hedge fund looks very inflated. Because those small funds which could not do a better job, which generated very poor returns, they are not added to the database. So the average is obviously inflated. And whenever they are reporting their returns, suddenly what happens is their returns are filled even for the previous years as well. And because of that, all those negatives could result in a kind of a big bias in terms of the returns that are coming up in the current year. So when you are removing the bias, probably it may be the case that hedge fund returns have not been that sophisticatedly higher. Whatever they are visible right now, it's not the case that once you remove the bias, once you include all the funds into the portfolio, their performance may not be anywhere drastically different from the performance of a typical mutual funds return. So we need to understand that aspect as well when we are trying to invest in a hedge fund. So these are some of the important aspects which I thought I should cover as a part of this session. We have spent a good amount of time trying to understand all these aspects, types of funds, NAVs of mutual funds, hedge fund versus mutual fund, return on hedge fund investment, all these typical topics. I hope you got a good amount of understanding of these different aspects associated with the mutual funds and hedge funds. Any further queries, you can very well get in touch with me by giving me a call on the number that I have given below, or you can even send in an email at the email address that I have specified below. Thanks a lot for listening to this session. Thank you very much.